Hello and welcome to our CEO interviews. Today I have in the hot seat Dan French, the founder and CEO of Consider. So as many of you will know, Consider is a business that has been in business since 2000 and specifically focuses on helping organizations improve their finance function and drive their finance function towards a world-class finance operation. So really pleased to have Dan with me today. Hello, Dan.
Hi, Susie.
So just before we go into the first of the four themes that we're touching on today, let's just find out a little bit about why it was in particular this area, this domain, that you found yourself setting up a business within.
Right, yeah. I obviously run the business, but I've always had an interest in processes, people, and systems. Now, obviously, a lot of people understand about process and a lot of people understand about systems. The piece about people I find particularly interesting is that how human behavior affects business and business processes and laws around anticipated consequences and how people tend to be the cogs doing things their own way, which isn't necessarily what we expect. So I'm kind of fascinated by that and how we make the whole process work better and help people do their jobs better.
And I know you've obviously got a lot of very recognizable brands that you've been working with over the last 13 years or so, many of them shared services organizations. So let's kick off and start talking about one of the themes then that a lot of shared services organizations struggle with, which is the control and compliance area. As far as you're concerned, when we look at control and compliance, and specifically around the effective monitoring of key financial controls, who would you say within the finance operation should really be involved in optimizing financial controls?
Right, that's a good question. I guess the first thing I'd say is shared services organizations are right in the cusp of helping organizations improve financial control. And I don't think it was really a primary objective, but it's been a positive side effect of centralization, simplification, and standardization that, generally speaking, shared services organizations have found their control and compliance challenges somewhat easier. I mean, if I take a classic example here of a very large non-governmental organization, typically, because financial controls these days are both business controls, but they are implemented to a large extent within big ERP systems, quite often organizations give the job, the specifics about implementing them, to an IT organization, which is a little dangerous. So in general, we tend to try and bring the finance function, the IT specialists, and perhaps internal audit folks together to make sure that what is desirable from a business point of view is implemented in technology in a sensible way, and makes the whole process of assurance through internal and external audit as easy as possible.
Mm-hmm. How easy is it to bring those three bodies of people together with that aim in mind?
I think it's easy enough if you speak plain business language. I think the challenge for a lot of organizations is in all of the systems, ERPs that we use, there's a lot of deeply arcane technological jargon and terms, and as soon as those phrases come out, everyone just says, well, let's leave it to the IT specialists. They obviously know what they're doing. So the critical thing is to focus on control objectives, what the risk we're trying to address is, and just speak and bring those people together is very straightforward, but you have to avoid the unpleasantness of technical mumbo-jumbo.
And also when bringing those three kind of teams together, are you finding as well that there's a bit more authority or influence or weight behind the business people, effectively the kind of the process people, the shared services people, whereas in the past that kind of power used to sit with IT? Are you seeing a shift there at all?
I think in the leading organizations a very healthy relationship and a balance, because clearly financial control is a financial responsibility. Implementing it in technology requires technology people. I do think that sometimes finance functions have abdicated responsibilities on financial control just because it gets too obscure in the detail. But I think by bringing it to a sensible level, the experience is the finance function become more comfortable owning their responsibility again. So I'd say they end up more in the driving seat they should be in, but it's a three-seater car, not a one-seater car.
So when they gather together in order to make sure that the monitoring of their key financial controls is indeed effective, are you talking about the fiscal control element? Are you talking about the process control piece? Which piece in particular are you kind of zooming in on?
The place that we spend quite a lot of time in this is all the classical financial controls which can be implemented in all or in part within ERPs. So it's everything from the segregation of duty through to the embedding the process controls such as three-way match and invoice tolerances and depreciation periods and all that stuff. So it's all of those things where we've got a clear set of financial risks, control objectives. We need to make sure these things don't happen, and then making sure they are implemented in a practical way without these unanticipated consequences, where people sometimes feel, I've implemented the control, I don't need to worry about it anymore, when in actual fact, that control may not really address the risk they're concerned about.
Mm-hmm. And who are you finding? I'm going to come on to what happens when you don't have the controls in place and maybe just tease out some examples of companies that you've worked with where perhaps it has gone horribly wrong and you've been kind of dropped in to fix it all. But who are you finding now, as far as ownership is concerned, it's actually signing off on the kind of the control gateways that a company might have in place to minimize any risk?
I think it's, these days in the best organizations, it's 70% finance and 30% IT. You have to remember there are some controls that affect financial reporting and a financial statement, which are deeply technical to do with what IT people can do in the dark of night. So those are the controls that perhaps IT executives need to understand and own. But the controls around the core financial processes, absolutely owned by finance. Okay.
And looking at your experience, Dan, are you finding that it's a particular function within finance that actually owns this, i.e. is it indeed the financial controller, the finance director, the shared service director, or is it the process owner?
Right, that's a good point. So again, talking about the car with a number of seats in it, the ultimate ownership of financial controls usually comes under the financial controller, but key stakeholders are the head of shared services, there's the end-to-end process owners, where those exist, and of course you and I have discussed before that those are becoming more and more dominant, but still not necessarily the global standard yet. So ultimately the process owner for, let's say, the purchase-to-pay process in a global company should own the process and the controls, but clearly the control piece of that does link up to the controller of the organization, who needs to be happy that the business is operating within the constraints they want to be in.
Okay. So what's the ideal scenario as far as having the effective monitoring of key financial controls in place? What is the ideal scenario from an organizational perspective and also from a systems perspective?
Well, the first thing is bringing the key stakeholders together. So we've talked about finance, talked about obviously process owners, shared services, IT, and audit, and I'd even suggest external audit in certain cases to make sure they can make their comments as early as possible if they've got any issues. And I think the first thing we have to do in these days, and we have been doing probably for a few years now, is try and recover from some of the excesses of Sarbanes-Oxley and these things where many organizations put in hundreds, if not thousands, of controls which were way beyond necessity. So first thing is optimizing down to what are the key risks that we really care about, and what are the controls we need to ensure are there. Then we need to make sure we understand what they are, we're all agreed, they're implemented as far as possible within our systems, and we have some way of monitoring that they are doing what we expect them to do.
So could you give a bit of an example, an anecdotal example then, Dan, of a company that you've worked with that's really got it kind of put in place very elegantly?
There are a number of, I think, best practice examples. I think consumer goods is a segment that's done particularly well in this area. And I think a very clear statement from the top, the classic, tone at the top, how we operate our company is critical to our financial and broader business success, steered by the CFO and actually the audit committee, driving the controller and the head of financial control to say, okay, we want to be clear that we've got the right level of control. We don't want too much, but we want to make sure what we have is appropriate for our business, and then coordinating with process ownership, shared services, and IT to implement that in ERP systems, most of which is there to some extent. But the challenge, of course, is, which comes back to the law of unanticipated consequences in human behavior, is we tend to assume that because a switch exists in an ERP system, and we believe somebody set it when the system was set up, that means the control's in place. And the devil's somewhat in the detail here, and we find lots of situations where we say, okay, so, for example, you've got a three-way match. Yes, we have a three-way match, and they're going to post a goods receipt without a purchase order. Nope, that can't happen. And then you find, well, actually, that has been set, but it's only been set for 20% of your vendors. So there's a lot of kind of complexity under the covers, which is why some monitoring process is important to make sure that what management expect is happening is actually happening under the covers. And so quite often organizations are rather surprised to say, well, I thought we'd set that. And of course the IT people said, well, yes we did, but we had to unset it for these reasons. And so you start finding some of the unpleasantness under the covers, and we've seen all sorts of things rather concerning to do with accounting periods being opened when they shouldn't, and so on.
Okay, well, we can flesh that out a little bit just towards the end of this chapter, but a couple more questions before we talk about what can go wrong. So what does monitoring mean? Is it somebody literally monitoring this on a daily basis, monitoring the controls that are in place on a daily basis? And I suppose my question is, how regularly should an organisation be monitoring their control infrastructure to ensure that the monitoring of process is what is expected and what is needed by the company?
Right. That's a very good point. So organizations vary from an annual check, if you like, to make sure everything's as it should be, which can be manual and intensive, or even quarterly. Some organizations do it quarterly. But more and more organizations now are moving to some form of technology-enabled continuous monitoring around their financial controls that basically inspects any changes to their ERP system as they fly, so people don't have to do it manually, but they're alerted to say, okay, something here is outside what you expected in your statement of financial controls, and either this control is no longer operating or it's not working. So there's a variety from those, I think, for people who do a point in time, they decide whether it's quarterly, 6 monthly or yearly, and either do it with an army of external people or some kind of analytics, or they want to implement some kind of continuous process so they know at the point when there is some kind of control failure or control weakness observed, they can deal with it before the effects of that start hitting the financials.
And what do you recommend? I'm guessing obviously the preventative approach rather than the reactive approach, but where do you think the balance is?
Well, it's an interesting question, and I think there is a healthy balance to be drawn. It would be lovely to believe that you could put in place 100% preventive controls, but sadly, both technically and behaviorally, that is just a complete pipe dream. So we need to have a good set of preventive controls, but we need to do two things. We need to monitor and detect whether those preventive controls are still operating, because for lots of reasons they change over time. And secondly, there are some controls which will never be completely preventive, because if they were, the business would stop working, because businesses do have exceptions in them, and the key point is working out what the appropriate tolerance of those exceptions are.
So some of this is systematic, as far as coming back to actual kind of control setup. Some of it is systematic and some of it is behavioural. So if we spend a little bit on the systematic piece, what is provided by and embedded in an ERP and what is not? You talked about a switch in an ERP, and if that switch is on, then some people assume that there's some controls in place. But what is the reality there?
Well, I think the reality is all of today's ERPs have controlling frameworks within them. So the broad set of financial controls, which cover the revenue cycle from sales order to collections, and from purchase order to payments, and around journal entries in the GL, there's basic controls which you can set, and best practice, it's pretty straightforward in ERP. I think the challenge is, because the ERPs are so complex, that it's not as simple as just saying, okay, well, set this one switch. In reality, it replicates all over the system, so some form of automated assurance is usually a good idea. And the ERP vendors, are starting to provide those things as well. So it's just usually an additional investment from an ERP vendor or an independent.
So from a technology perspective, what is the best approach?
The best approach is to make sure you have a controls monitoring capability from whatever source that monitors the key controls from access, segregated access we talked about earlier, ensuring that actually happens, and ensuring that where a segregation of duties cannot be implemented for reasons of a small organization in a remote area, that effective mitigating controls are implemented, through to ensuring that the process controls we defined at a business level are actually working. So, for example, that three-way match is actually working in practice and there are no exceptions to it. That is really the best practice, to make sure there is a monitoring capability over and above the core settings in the system.
Mm-hmm. Okay. So it sounds like that's potentially like a bolt-on application.
Yes, broadly.
Okay. Yeah. And what about the behavioural checks and balances that you can put in place? How is that embedded in the mindset of an organisation?
I think a lot of this is really about education. I'm sure I know you, Susie, and many of those listening have seen the lovely photograph of the car park in winter and the car park barrier that doesn't open until you swipe your employee card. But in winter you see the tyre tracks through the snow. So the key point is helping people understand that however good your parking barrier is, there's always an opportunity for tyre tracks in the snow. And frankly, that's one of the biggest risks for a lot of organizations, is the bland assumption that these parking barriers within our system are actually capturing all the cars. And the reality is they're not. So once people understand that, then they take a broader view and they're less likely to be impacted by this blind belief in the controls in the system, and take a broader view so they understand the role of monitoring for these things. They understand how to ensure that it's not enough just to say all our controls are set. We need to make sure our processes really work that way.
Let's just wrap up this chapter with what can go wrong. So in your experience, if you can just draw on some anecdotal evidence to illustrate the horrors of what life does look like when you actually do get this wrong, what would those be?
Well, I think some of the classics that we've seen have been organizations who've decided to take perhaps a slightly overly academic route and design and implement thousands of controls which basically tie up the business in glue and become very costly, and they need to cut that down. So that can be pretty unpleasant, just to say, look, you've got way too much here, this isn't helping you. And so sort of unpicking that can be a bit of fun occasionally. I think at a more practical level, I think it's interesting that everyone who's got an accounting background understands the principle of segregation of duties. You don't want the same person performing activities that could give you a conflict of interest and result in some misappropriation of cash or assets. But we've seen a situation where implementing a new ERP system, a new process, moving to shared services, and implementing a segregation of duties process, the organization out in their global operations, some of the local units have said, well, this is very interesting. What we'll do is we'll just, because we've got this new ERP system, we're going to hire new people who'll just enter all the data in for us, which, because they saw this potentially, the new system adding perhaps some more work than they hadn't expected, which may or may not have been the case. But the interesting point was we had to catch this fairly early, because clearly it could completely undermine any approach you have to segregation of duties, because the people who are actually making those decisions and applying stuff were just handing information to people who are essentially just typing folks. So, occasionally you just have to make sure people understand that organizational decisions, process decisions, and control decisions are all related. They need to think about that in the context of human behavior and how work actually occurs.
Okay, good. Dan French, thank you very much. Join me in Chapter 2, where I'm going to be asking Dan French about risk and specifically identifying and eliminating waste and error in the finance function. Thank you.